Alrighty, folks, we are on the cusp of a dramatic boom in what is called accidental landlords. In fact, the Wall Street Journal is talking about the growth in accidental landlords. I thought we should have a conversation about what is it, why do you do it, what you should consider, and maybe, if you listen to Graham Stephan, why he refused to be an accidental landlord in one of his properties. We're going to have this conversation with Mike, the CEO of Rentometer. How you doing, buddy?
I'm doing great. Thank you.
Awesome. Again, I think there is no question that accidental landlords really have always happened. I think we're on the cusp of a dramatic boom, probably to the tune of 3, 4, maybe even 500% when we look back over the next decade. But Mike, I think we should probably define first what an accidental landlord is. What say you? What is an accidental landlord in your opinion?
Accidental landlords have been around for a long time, especially since the financial crisis. Financial crisis really was the original boom in accidental landlords. If you can't sell a house, probably the next best thing is to rent the house. So that happened, and there was kind of this recognition that, hey, this is actually a viable path. And as we've talked in the past, technology has really facilitated a lot of or automated out a lot of the hassles of being a landlord. So,
For sure. Yeah.
so now it's not as daunting a task. So more people are contemplating it, and simultaneously, the market is stalling a little bit in a lot of markets on the sales side. So, and as the Wall Street Journal pointed out, most of those homes, people lower the list price to sell them, but there is a significant percentage, or I should say, a material percentage that are not selling and are taking the accidental landlord path, where they say, I want to hold the asset. I think it's worth more. Let me rent it.
Yeah. When I think about being an accidental landlord, really, to me, it's at the point of purchase or the point of acquisition, right? You were buying a home for your family. You intended to be there for years, and then life events happen: death, divorce, job transfer, school, whatever. And you're faced with a decision. To your point, do you sell it? Do you take the equity and run? Do you use it as a down payment for the next one? And you're right, absolutely. The GFC, you couldn't sell your home. You were competing with REOs and short sales. You know, you were upside down. There was lots of reasons you became an accidental landlord. Today, it's really a different story. I think there are people today. I know people that have a mortgage rate that starts with a 1, like 1.99, 2.05, right? They're just ridiculously low interest rates. And they're looking at that, and I think correctly, Mike, realizing that that's a financial asset, right? If you can borrow money for 30 years at 2%, right? How much of that can I have? Yes, please.
All day long.
All day long, right? So I think this is really, and this is why I think accidental landlords, when we look back in a decade, they'll be up 2, 3, 4, maybe even 500%, because it's just a wise financial move. Right. But you know, yeah, go ahead.
Yeah, well, and so to continue that thread, right? It's potentially a wise financial move. Your cash flow clearly is going to be more positive than if you were signing on to a 7% interest rate. But I think you have to be careful and think about how to evaluate the deal and how to make sure you're getting a return. Because as we've talked about before, real estate is an asset class. There's other asset classes. Can I get a better return if I just sell it and take the equity and stick it in a money market account, right? So you have to evaluate, how much do I have in the deal? And what is the cash on cash return on that? And then what are the hidden returns via appreciation and mortgage pay down?
Yeah.
And so I think you have to take that equation, and you just have to say, oh, I'm not, like, when you buy an investment property, you take money out of your bank account, and then how much am I getting back on that, right?
Yeah.
That's easy. If I own the property already, I've already made my down payment. I already have some equity in the deal. So how much am I leaving in the deal? How much cash? If I sold it, I would take out, let's say I'm 33% in on the
Hmm.
equity. So on a $600,000 deal, that's about almost $200,000, right?
Right. Hmm.
So I've got $200,000 in. Now I need a return on that too. What's my return on the 200,000? It's not a return on. You can't look at it from the standpoint of I don't have anything in the deal because I already own it,
Right.
and so all my cash flow is just positive because that 200,000 could be someplace else doing something else.
Yeah,
Something
the
else.
opportunity cost for sure. Yeah.
Hmm.
And it's funny we're talking about accidental landlords because Graham Stephan, a friend of mine, just put out a video today about a home in Santa Monica. And all of these, I watched the video about an hour ago, so it's recent memories. But if I misquote anything, it's not intentional. So Graham Stephan bought a home really close to the water in Santa Monica. As I remember the story, he bought it for $2.1 million. He
Hmm.
then obviously moved to Las Vegas, and the house has basically been vacant. And he thought about being a landlord, but unfortunately, Santa Monica has what's called rent control.
Mm.
And while the house could rent for about $12,000 today, he would be limited on future rent increases to the tune of $60, 60.
Hmm.
So that's like 0.5%. And that's, when you look at your insurance, you look at your property taxes, you look at, all the expenses, that quickly gets eaten up. Also in Santa Monica, they have some crazy rules about basically homeowners giving up all their rights if they want to become landlords. So again, sometimes it's about where the asset is, right? If
Totally.
you're in LA County or heaven forbid Santa Monica, like my friend Graham, there's just no reason to keep it, right? Why would you give all of that stuff up in? And then lastly, to the point you just brought up, he's like, okay, I bought it for 2.1. I got lucky in 2020, I think, and he sold it for like 2.6 or 2.7. And he's like, I'm just going to put it in a muni bond.
Yeah.
Again, he's going to put it in a muni bond, stress-free, in cash
Yeah.
flow just as much or more. So back to your point, don't look at the equity there and think it's
Even
nothing.
Yeah, and there's some downward pressure whenever those what we like to call operational complexities come into the
Yes.
deal. It creates downward pressure on the value. So
Yeah.
the appreciation value is at risk. Certainly, you could take some debt against it, and you would have mortgage pay down.
Hmm.
But the cash on cash probably wouldn't even be there on a
Oh,
$2.1 million deal, anyways. But if you're playing for appreciation now, Santa Monica, it I guess if you're playing fantasy sports, you'd say
yeah.
it has a low floor but a very high ceiling, right? It
Yes.
could
It-
become something very big, but
yeah. But
but
that
the
but
floor
that
the
that the
floor
risk
is
of
risky.
yeah. Yeah. The other thing you got to remember is tax advantages, right? Because if you buy the house, you live in it full time for 2 years, and it's 2 of the last 5 years, he could take all the gain out tax free, right? IRS gives you 500 grand if you're married, and he is married,
Mhm.
right? 250 single. Five again. There's just it's back to being an accidental landlord. I think a lot of people expect me as the one rental at a time guy to say, yeah, just keep everything. And I got to tell you, Graham Stephan did the right move. Right?
Yes.
Why would I, there is no reason to be an accidental landlord in Santa Monica if it's a communist, capital of the world or whatever it is.
Right.
Just sell it, move on, peace of mind, headaches, muni bond, right? Just take the tax savings. I mean, it's just makes total sense to me why he did that.
Yeah, I agree, and I think there is a cap on in terms of the value of the property where you really have to it, once you get above a certain limit, and it's market driven, it's market by
Sure.
market, but once you get above a certain value threshold, it's not going to be your run of the mill rental property, and that will just again that introduces operational complexity. When you have operational complexity, you need a higher yield.
Yes.
And what I mean by operational complexity is just is it what's the area like? What's the crime rate like? What's
Hmm.
the uh, statutory? What's the structure of the government, and how involved is the government in the the management of rental properties
Yeah.
and the requirements owning rental properties? So those factors are definitely important.
Yeah. But at the end of the day, folks, I think most of us are not buying properties in Santa Monica. We probably wish we could, but we're not doing that. I think a lot of you should think about becoming accidental landlords. I think you should understand, don't look at it as your home, look at it as a financial asset. Because again, I think a lot of new investors or maybe property owners, they get kind of distracted by like, this was my home. It's where I raised my babies. And like, no, if you're going to move on and make it a rental, become an accidental landlord, it's just another financial instrument. What do you think?
Yes, I agree. And one of the things that I've looked at is the down payment, so to speak. What is your equity in the deal? And believe it or not, the optimal move, if you can do it, I think, and this is I'm throwing this out there as a theory, so it is definitely
Okay.
not advice. I don't want to give advice, but when you run the numbers, if let's say you have 35% equity in the deal,
Mhm.
you're better off if you can maintain the interest rate, which is the tricky part. I don't know if you can maintain the interest rate, but if you can, take 15% off the table, leave 20% in, and you
Mm,
really juice your yields because of the appreciation factor. And
sure. Leverage.
it's still not a bad deal if you got 35% in. It's just going to be a lower return, but it's almost like take some off the table and do the
Yeah.
deal. So you just have to be aware of that, because some people, their property is paid off and they just don't want
Yeah.
to sell the asset. So you have to really factor in that opportunity cost.
Yeah. It's funny you bring that up again. I think if you're in growth mode, again, my opinions, no, not financial advice. I don't see any reason to have an investment property paid off if you're in growth mode. If you're in
Mhm.
chill mode, do whatever you think's reasonable.
Yes.
Neither here nor there. But if you're growing, I see no reason to have a rental property owned free and clear. If you want to own your primary free and clear in growth mode, by all means, if it's peace of mind, if it's Dave Ramsey, whatever it is for you, realize that will stunt your growth, right? Mortgage pay down to that tune is going to obviously hurt your growth. But yeah,
Yes.
to your point, like if you own your home free and clear and then you want to make it a rental, go get some debt. Because
Yeah.
go get some,
Lever it somewhat.
go get
Not crazy.
50%. No,
Yeah, don't put
50%. Yeah.
100%.
Great.
Just
Yeah.
get some debt on it, and
Yeah.
you'll lever your return.
Absolutely right. Mike, this is always fun conversation. I appreciate them. If somebody wanted to check out Rentometer, where are we sending them?
So rentometer.com, and if you are in that mode of accidental landlord, or you just want to evaluate a deal, we have a new deal worksheet up.
Nice.
Just go to rentometer.com, right on one of the main menus there, under, I believe it's under products. Look for deal worksheet, and
There you go.
you can run an evaluation, cash on cash, get the gross rent yield, and then run a quick cash on cash calculation. And we use live rent, so we're using real time rent data, hyper local for your property. So,
Yeah, man, you're doing great. You're doing great work, Mike. I appreciate you. Have a great week.
all right, thank you.
Mhm.